Welcome to our series on sources of finance. This series will comprise 3 videos. This video will cover the basics of financial markets with a focus on South Africa. The second video will consider rights issues, and the final video will look at debt, equity, and hybrid instruments. Let's look at our learning objectives for this video. First, we need to understand the different classifications of financial markets. Next, we will identify the different stock exchanges in South Africa and what roles they play in the economy. We will then describe some of the main instruments that you can expect to find on a stock exchange before discussing the methods of obtaining a listing. We will end off by briefly understanding the role played by financial institutions. Let's begin by looking at some common financial market classifications. It is important to remember that markets can often fall into more than one category. First, we have money markets. These are markets that are used for raising short-term finance. Key participants are normally the major commercial banks and large organizations. On the other hand, we have capital markets. These markets are used for raising long-term finance and would generally include the major stock exchanges such as the Johannesburg Stock Exchange in South Africa. We then have primary and secondary markets. Primary markets are used for new issues of finance, such as initial public offerings. A secondary market is used for trading shares that have already been issued. The formal market is a regulated market that specializes in a narrow range of instruments. A stock exchange would be considered to be a formal market. These markets are also easily accessible to small or individual investors. An over-the-counter market is an informal market that is for non-standardized or specialized instruments. Finally, the spot market is when instruments or commodities are traded immediately at the current or spot price. A share would generally be traded on the spot market. Alternatively, the derivative market is a market in which the value is derived from the price of the underlying item. Futures and options would generally be traded on the derivative market, with the underlying item being some share, currency, or commodity. Let's now have a brief look at the stock exchanges in the South African context. Our main stock exchange is the Johannesburg Stock Exchange, or JSE. It currently has around 300 listed companies, and this has been declining in recent years. The exchange was established in 1887 and serves as both a primary and secondary market. Remember, this means that you can raise new finance through issuing new shares as well as trade existing shares. The JSE operates a number of markets. First are the equity markets, which comprise the main board, which caters for South Africa's biggest companies, and the alternative exchange, or ALTX, which is designed for small to medium-sized companies. The JSE also operates a debt market, which trades corporate and state-owned bonds. Finally, it operates a derivative market for the trade of options and futures. South Africa's second exchange is the A2X, which was established in 2017. Currently, it only serves as a secondary market, but this is set to change in the future. A key difference to the JSE is that there are no costs to being listed on the A2X, making it a cheaper and therefore more attractive exchange for companies. Now let us look at the types of securities listed on the JSE. We should all be familiar with ordinary shares. These represent the ownership of a company and have the right to any residual profits after paying out any debt and preference shareholders. Preference shares entitle the holder to a fixed dividend, which takes priority over ordinary shares. Preference shares can have many extras attached to them. For instance, they could be redeemable or irredeemable, participating or non-participating, and cumulative or non-cumulative. Next, we get warrants and options. They are both the right but not obligation, to purchase a share at a specific price on a specific date. The difference between them is that warrants are issued by the company itself, and the company issues new shares for the transaction. Options are generally listed on exchanges, and the company itself does not get any proceeds. Options generally last for a shorter period of a month or two, while warrants can last up to 15 years. You also get call options in warrants and put options in warrants. A call is the option to purchase or buy, whereas a put is the option to sell. We also get American and European options. The difference here relates to when the option may be exercised. A European option can only be exercised on the expiration date, while an American option can be exercised at any time before the expiration date. Finally, we get futures. A future is an agreement to buy or sell a specific commodity or share at a set date for a set price. A future differs from options and warrants in that the future holder has an obligation to purchase the underlying item, whereas the option holder has no such obligation. So how do we obtain a listing on the JSE? There are four main methods. First, we have an introduction. This is when the company already meets the requirements in terms of share capital and number of shareholders. Nothing further needs to be done, so the company is simply listed. A private placing is when the company does not meet the minimum requirements. As a result, shares are then sold directly to institutional investors in order to make up any shortfall. A public offer is again when the company does not meet the minimum requirements. However, this time the shares are offered to the public. A public offer can take the form of an offer for subscription or an offer for sale. An offer for subscription is where the company invites the public to purchase new shares which will be issued. An offer for sale is where the existing shareholders sell some of their current holdings. In an offer for subscription, the company gets the money, whereas in the offer for sale, the existing shareholders get the money. A public offer will often be underwritten, and the company will be required to have a prospectus. Finally, we have a backdoor listing. This is when the company lists by purchasing a company that is already listed on the JSE, generally a company which only holds cash, also known as a cash shell. Let us wrap up this video by looking at the role of financial institutions. First, what are financial institutions? Generally, they include banks, institutional investors, private equity financiers, and venture capitalists. In South Africa, we also have a few specialized institutions that were developed for specific purposes such as empowerment. These include the IDC, the PIC, the NEF, the SEFA, and business partners. Now, what is the role of these institutions? These institutions act as intermediaries for directing the flow of capital by bringing borrowers, those who need capital, and lenders, those who have capital, together to transact. That brings us to the end of our video on an overview of financial markets. In our next video, we will look at rights issues. See you next time.